You're about to see breaking market intel that will mess with the AI bull run narrative. Mixed signals are flashing, gold ripping to records, long end yields threatening to climb, and classic divergence warnings under the hood. If you're only watching the indexes, you're missing the pressure building in rates, transports, and consumer names. Stay with me. This clip sets the stage, and I'll connect the dots so you can protect your portfolio and still ride the upside.
Peter, what are interest rates telling you about the state of the U.S. economy right now? another deep thought-provoking question from us.
When we think about interest rates, it's like most things in markets, it's not the level, it's the rate of change.
Sure.
And the rate of change in interest rates has been very slow. And if we're talking about words, there's a phrase in markets which says, if a market gives you too much time to make a trade, don't make it. And in my mind, it's given you way too much time to buy bonds thinking that interest rates are going to go lower. What we kind of know as facts, right? The demand, because the deficit continues to grow, so the demand that the government's going to put on markets, i.e. issue more debt. So when you have more supply, right, prices are likely to go down, which in the bond case, interest rates go up. Also, there's a few subtle things that further put pressure on rising rates, including accelerated depreciation, so there's going to be less revenue, the permanent movement in terms of capital gains rates, so there's less incentive to sell, more incentive to borrow, right, if you want liquidity.
So the changing
all
tax
these
landscape.
things are likely to indicate more rate increases on, say, let's say from 5 to 30 years. Now, the Fed tries to control the front end, and we can discuss that in divergences more in a moment.
Yeah, I appreciate that. And maybe we just keep with interest rates right now, because I think you hit on some very good points here that I just want to kind of reiterate. The Fed is acting on the short-term rates. That is the overnight rate. But when we think about mortgages and the borrowing that most people do in their lifetime, those will be done on the longer end. And that's not what the Fed directly controls, at least right now. Sometimes in the past, it has actually done that. It's gone and tried to control the long end, but that's not what it's doing now. Now, the Fed is in the midst of a cutting rate cycle. And so it's cut rates 2 times this year, starting in September. Also, by coincidence, it was cutting rates last September. And what happened last September is the long end rates went the opposite direction. They went up. And for a short period of time, there was a scare. It seemed like that might be happening again, but they've come down. But what you're saying is we might have those longer term rates heading higher again. Just kind of outline that risk for us, if you would.
So one of the most popular jobs on Wall Street is every 3 months forecasting that the Fed is going to cut in 3 months. So we were approaching December with a data vacuum because the government has been closed, but market prices are telling us in a lot of ways. You mentioned gold at the very beginning.
Yes.
Gold being at this level, silver being at this level, which, by the way, silver took out its 1980 high.
Yeah.
So I think 45 years later, we should all be having a party, which indicates to me that you're never wrong, you're just early. And so in the case of the Fed, markets are telling you, wait a second, inflation may be picking up. We're seeing that particularly in some markets. As you know, I'm a big fan of what I call the 7 C's.
Yes, we've done that before. Yeah.
Yes, and I'm not going to go through all of them right now, but this is a very conflicting period because some C's are weak, some C's are strong, and some are in the middle. So the Fed, like the rest of us, is in a little bit of a conundrum. Though, should they cut with the deficit expanding? Should they cut with energy prices, not crude, we look at that, but electricity prices, the demand for that, high prices in equities are not telling you that there's the economy slowing down. And in fact, the Atlanta Fed GDP figures are also in the upper 3s. Those are not rate cutting environments.
Yeah.
Here's what matters and why. The headline isn't just rates or gold, it's rate of change plus breadth. When deficits force heavy treasury supply, the 5 to 30-year part of the curve can rise even as the Fed trims the front end. That squeezes valuations and tightens financial conditions where real people borrow: mortgages, autos, capex. Meanwhile, transport's moving sideways while the Dow grinds higher is classic Dow theory divergence. Demand for moving goods isn't confirming price strength. Add gold at record territory and a firmer dollar, and you've got a policy confidence tug of war that often precedes volatility. Actionably, watch long-end yields, the dollar, and new 52-week lows in prior leaders. If those expand while indexes sit near highs, hedge, trim exposure, sell covered calls, or layer puts, rather than predict.
The perfect segue for today's market show and tell, where we are breaking down divergence. That is when related markets or indicators move in opposite directions. Divergence can point to potential turns in the market or economy. One classic example is Dow theory, which looks at the Dow Industrials and compares their performance to the Dow Transports. So it's the companies that make the things we use versus the companies that ship and transport the things we use. So Peter, what are you seeing here?
Well, the transports are supposed to be a bit more responsive and indicative to economic growth. And so they've been going sideways for a while, reiterates, if we can use that as a new word, the Fed conundrum, because does that mean the economy's weak or strong or somewhere in between, which is probably where it is? That's the challenge. So this transports have been going sideways. Sensitive commodities, whether it's UPS, which we saw, some of the railroads are not moving the same way that the Dow is. Now, the Dow, for you people that like, and I'm really good at this, of sort of keeping very insignificant information, made its high on October 29th. If we want to think of a period similar to this, October 29th, 1973 was the highest high of the Dow prior to the start of the long sideways move from 73 to 82, which also corresponded to rising inflation, increased unemployment, and significantly higher interest rates.
Yeah, that was the stagflation environment.
That's correct. And guess what took off over that period of time? Gold and silver. And then the irony, of course, is soybeans took off because the Nixon China strategy, China agreed to buy a bunch of soybeans. Is there going to be a replay?
This is the Cryptagon. Stay sharp, stay informed.